What's up, guys? Jay Martin here. My guest today is Peter Boockvar, the Chief Investment Officer at Bleakley Advisory Group and the editor of the Boock Report, where he publishes daily his thoughts on the macro environments and the markets. Today we got into everything from broad equities, vaccine-led recoveries, the commodities market, the Bitcoin market, and I opened up my portfolio to Peter to get his thoughts on how I'm doing, where I may be missing opportunities, and it was interesting to hear his perspective. So I hope you enjoy this. As always, if you do, hit subscribe, turn on notifications, and right beneath this video, there's a pinned comment where you can subscribe to my weekly newsletter. It's free. I publish every Friday, where I essentially debrief the lessons and the perspectives that I hear on this show every week. I'd love to have you join the tribe. All right, enjoy.
What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now, finally, Peter, by Peter Boockvar, the editor of the Boock Report and the Chief Investment Officer of Bleakley Advisory Group. It's good to see you. It's good to have you on the show.
Nice, Jay. I appreciate having me on.
I feel like this has been a long time coming because we've exchanged a handful of emails over like the last 4 or 5 years. And, I think it was Danielle DiMartino booth I had on the show. And when we started talking about commodities, she pretty much pushed all of the questions, said, I got to go to my expert, Peter Boockvar, whenever you ask me about commodities. So I'm glad to finally have you on. Now, here's where I wanted to start, Peter. We wrapped up 2020 with like no end to the fear narratives, right? The market's going to crash. This is unsustainable. There's this decoupling between the market and the economy. This won't last, all of this. I've seen all of those headlines become very quiet in the last couple of months. To the point where one of the biggest advocates for the insolvency crisis, Raoul Pal, is now calling the markets bulletproof, and maybe we're past this. So I'd love to just open up with that, get your thoughts on the state of things today, Peter.
Well, I think before I get to today, I think it's good to sort of summarize 2020, because when we closed the books on 2020, you saw, okay, we had the worst pandemic in 100 years, and why was the stock market up? But within the stock market, it was sort of two markets for most of the year. Once the pandemic hit, it was, let's buy, obviously you had the crash, but after that, it was buy the work from home stocks, buy all the stocks that benefited from that and work from, and learn from home, and everyone just doing everything at home. Yeah. And they sold everything that benefited from being outdoors, whether that's leisure and hospitality or purchasing any other services. And then on November 9th, you had the Pfizer news saying that their vaccine is more than 90% effective. And then all of a sudden we had this switch, and everyone piled into the out-of-home stocks and took a breather on the work-from-home stocks. And then we got into 2021, where all of a sudden you had, coincident with the optimism with the vaccine, a pretty rapid rise in interest rates that initially hit all the high multiple stocks that worked in 2020, but more money shifted into those stocks that got hit mostly due to COVID that only started to rebound, as I mentioned, on November 9th. Right. So here we are digesting earnings season. And I think with the backdrop of a market that is extremely expensive, but has been for a while, and expensive is no timing mechanism. But when you combine expensive with a change in the rate environment, the 10-year yield has gone from 90 basis points at the end of the last year. Right now, it's about 157, 158, got as high as almost 180. You combine those two and a heated discussion on the direction of inflation and growth, and is at as good as it gets with respect to the earnings rebound, because we've seen some very good earnings reports over the past couple of weeks, particularly out of big cap technology, that were not rewarded by the market. A few were, but many were not.
Were you surprised by that?
An interesting juncture here. Well, I'm not so surprised, considering how much these stocks have already been up over the past couple of years. Yeah. And so you need that sort of that backdrop. I mean, you take Apple, for example, and I have no position either way, but they benefited a lot last year from people buying laptops and iPads, all the work from home, learn from home things. And that strength continued in the first quarter, but you still have to ask yourself, how sustainable is that? A large part of the rally in Apple in 2020 was multiple expansion. Earnings really didn't do anything last year, but the P multiple went from 15 to 30. So with that kind of backdrop, with that kind of setup, and the belief that maybe this is as good as it gets in terms of the growth rates, I think it was definitely an excuse to see a pullback. And that's not just happened in Apple; it's happened in a variety of different stocks. Take semiconductors, for example. There's all this talk every single day about shortages of semiconductors and how it's clogging up the entire supply chain of anything that relies on them, particularly auto companies. Well, students of markets and veterans of trading semiconductor stocks know that it has historically been a boom and bust type industry. And when you see the type of business they're doing now, there's the memories of double and triple ordering that eventually leads to a hangover on the other side. And considering how well these stocks have done, well, the market is saying, okay, this is as good as it gets. And I think that theme is sort of beginning to sink in during this earnings season. That I think is the reason for this little pullback. And this pullback is tiny. I mean, the S&P 500 is just back to where it was a couple of weeks ago. The NASDAQ is just back to where it was a month ago. So this is nothing. But I think just trying to help explain why we've sort of seen a little bit of indigestion during this earnings season.
Sure. And a little bit, you're right. A little bit's the key word, right? It's
exactly.
Not too head turning. Is there anything, so is that your forecast then? Like, can we expect nothing but the Fed to do whatever it takes to continue this market rally and just more of the same, sort of rinse and repeat for the next 3-4 years? Or do you have any expectation of anything different?
No, I think what's noteworthy about this year is that irrespective of the Fed's desire to keep the Fed funds rate at zero for years to come and continue on with QE, that has not stopped the bond market for thinking on its own and speaking out and setting interest rates where they think they should be.
Sure.
So not only, I mentioned the 10-year rising sharply this year, you take the 5-year Treasury yield, which is kind of in the reach of the Fed's overnight rate in terms of its market pull and market influence. But that rate's gone from 35 basis points to north of 80 basis points this year. So that essentially is a 50 basis point rate increase, essentially. So I think the bond market is going to speak for itself with or without the Fed. And if the bond market thinks the economy is overheating, if the bond market feels that inflation is rising to a point where they can't tolerate, then you're going to see a rise in interest rates regardless of what the Fed wants.
Okay. And what are your thoughts in regards to inflation rising to a place that we can't tolerate? Because right before I hit record, you mentioned this is one thing that you're worried about.
That's definitely my biggest concern about when you look at what can upset the apple cart here and is a sustainable rise in inflation. I say sustainable because there's certainly a huge debate right now about the increase we've seen in inflation the last couple months, whether it's temporary or not. Fed has gone on the record thinking that it's transitory, and they're sticking to that, of the belief that this is more sticky and more sustainable than they think. And I think this summer, when people realize that, if I am correct, then you'll see another leg higher, not just in the inflation stats, but in interest rates. And in a very over-levered economy with valuations rich in many different asset classes, the worst thing that can happen, the thing that can, as I mentioned, can upset the apple cart, it is a rise in interest rates driven more by inflation than growth.
Got it. Okay. And I'm seeing a lot of that, I guess, inflated prices and a lot of assets. But where is their value right now, Peter? What's underpriced? What's worth buying?
So while commodities have had a nice run here, I still think that they're underappreciated because people question the sustainability of the increase. And I still think that these stocks are still well off their highs. You take energy stocks, for example. Earnings for some companies are back to where they were pre-COVID. Oil back to where it was pre-COVID, but these stocks are still well below where they were pre-COVID. And while the world is certainly shifting to more renewables and EVs and so on, what that also means is that you're going to get a lack of investment in energy. And that's going to mean more sustainable, higher prices. So I think that there's an opportunity there. I think you take agriculture stocks, particularly fertilizers, they're still down a lot from where they've been. So I still see value there. I see value in precious metals. I see more value outside of the U.S. I think when you look at over the last 10 years, the U.S. market has so outperformed everybody else that the market cap of the U.S. relative to U.S. GDP has sucked a lot of oxygen out of the room. So when you look for value, it's going to be outside the U.S. It's going to be in Asian markets. It's going to be even in parts of Europe are more attractive to me than U.S. markets. So I think that in search of value, which I always try to do, I think investors have to widen their geographic focus and look at other parts of the world in addition to the U.S.
Okay, thank you for that. Now, in an inflationary environment, where are we safe? First, why don't I give you my portfolio and you can tell me what you think, how I'm doing, right? So the way I'm set up right now is I've got nothing in the broad equities market. I'm completely out. About 80% of my net worth is tied up in real estate, cash, gold, and Bitcoin, in that order, actually. And the other 20% is highly speculative. And I play the commodities market. It's good at what I know. I know the early stage commodities market. That's where I spend a lot of my time. There's some outliers in there. I've got some investments in the food sector and in health science. But generally speaking, that's how I look right now. Any feedback, comments, Peter?
Well, I think it's important that you focus on things that you know and understand, because I think that that's an important aspect of creating one's portfolio. Now, of course, plenty of people go to financial advisors. It's what we do here at Bleakley is providing that advice for people. But for those that still want to do it themselves, doing it in things that they're comfortable with and they're knowledgeable about, I think is important. So it sounds like your portfolio certainly leans towards sort of the almost the anti-fiat money portfolio with Bitcoin, gold, and commodities. I'm all for that trade. I do think that technology companies, tremendous companies with great growth prospects, but high valuations, whereas everything else has sort of been neglected for years. We've had this either-or market, and I do think that we're going to continue to shift towards more of the value bent and more of the inflation hedges. The companies that survive inflationary type environments are those that have pricing power, because when you make something right now, regardless of what it is, whether you're making a Twinkie or you're making a computer or you're building a building that relies on steel or building a home that relies on lumber, you're experiencing major cost pressures. And those companies that are able to ride through that are those that are able to pass that on to their consumers, their customers, their clients. So if you can do that, I think those are sort of ways of protecting yourself from inflation. Now, you don't benefit from inflation. It just sort of immunizes you if you do have that price pressure. If you don't have that price pressure, then this is going to be a major margin hit for you, and that's going to be trouble for your earnings. And then, of course, those that benefit from the rise in inflation are going to be the Bitcoin, the gold, the commodity-related stuff, where just by nature of what they do, it's an automatic inflation hedge.
Okay, now just because I have to get the YouTube comments fired up, Peter, give me your perspective on Bitcoin. What is it to you?
So I'm a believer in crypto. I'm a believer in the ecosystem that's being created here. The only thing I don't know about Bitcoin is I don't know what it's worth. I know in 10 years, 20 years, many years, decades ahead, it'll be here. I just don't know if it's worth $55,000, $555,000, or $55.
Sure.
So I don't know. I'm more confident about saying that digital world and the world of crypto and NFTs and that is where we are headed. But I just don't know how to value Bitcoin, sort of within that. Bitcoin's going to be an important piece of all of this. I just don't know should it be just a speculative instrument? Or is it going to be eventually a form of exchange and payment?
Right.
Or is it just going to be, just another store of value like gold is, something with limited supply, and that will vacillate with people's opinions on the US dollar and other currencies and where inflation goes?
Now, if you would make a bet on one of those three, because I have the same question in my mind and I don't have the answer. Usually I'm very clear on why I buy something. And because of that, I also know why I'm going to sell it, So therefore, if I believe Bitcoin is a speculation, then I should be de-risking and taking profits right now. If I believe it's a future currency, then I should probably be buying as much as possible, regardless of the price, because by the time there's any kind of widespread adoption, the price will quintuple, right? Whereas if I believe it's a safe haven asset, then I'll do what I am doing with Bitcoin, continue to dollar cost average in because I want a horse in the race and I don't lose sleep over the price. Now, it's a conceptual question, so it is what it is. But if you were to bet on which of those three it is, Peter, or do you have an opinion? Do you lean, or do you kind of like wait and see here what's going to happen?
The thing with making a prediction here is that Bitcoin is 13 years old.
Yeah.
And with such limited history, it's hard to say where it's going to settle out. Like I said, is it going to settle out like gold, and that it's just going to vacillate with the level of interest rates and people's opinions about fiat currencies? I mean, because that's why gold was created, right? I mean, it was created for the same reason why people wanted to own gold. It was the anti-central bank currency. It couldn't be printed away. It was going to be finite in its supply. It was the exact reasons why people have been owning gold for 5,000 years.
Yeah.
But you take gold, for example. Gold went from $35 to $850 in the 1970s. And then 20 years later, it bottomed at $250. It's still this incredible multi-thousand-year store of value, and something that has stood clearly the test of time for that many years. And you can't say that about many things in the world.
No.
That you can still hold in your hand. But it went through a dark age for a couple of decades. So can Bitcoin still be around in 100 years? Yes, but it's going to have its booms and it'll probably have its busts while there's still going to be Bitcoin. So I still don't know yet how it's going to end up sort of in the financial ecosystem in terms of its usage. Again, whether it's going to be just a store of value, it's going to be a form of money and payment. My only issue with it being a form of money and payment, the problem with that is that every time you sell it to buy something, you got to pay taxes on it if you have a gain. So
Right.
you hear some companies saying, okay, we're going to accept Bitcoin as payment. Well, yeah, on paper, it sounds all well and good. But if I'm a holder of Bitcoin and I got a huge embedded gain, do I want to sell the Bitcoin, realize a gain, pay a tax to just buy that item that I can use cash with?
Yeah. Okay, I'm with you. All right, now I want to back to the economy, back to the potential of a vaccine-led recovery. First of all, is this something you're considering? Is this real? Are we going to see some kind of a vaccine-led boom? And if so, what industry should we keep our eyes on?
So there's no question that the vaccine was the greatest stimulus plan and program that you can ever invent. It will allow us to get back to where we were, to get not just our lives, but hopefully many jobs that were lost will come back, particularly in leisure and hospitality that were most impacted, and especially restaurants, for example. So we're going to have a great few quarters ahead. The question is that with this rebound, which it would happen on its own, is going to overheat because of all these supply chain problems that in itself creates a slowdown. If you're an auto plant that is now shutting down because you can't get semiconductors, well, the demand side's fine, but you're still shutting down because you can't make a car because you can't get enough semis. And then you throw in a lot of government spending that is throwing the potential of overheating the economy, which then leads to excessive inflation, higher interest rates, that then ends up slowing growth. So it's going to be a really thread the needle type situation. And then you look at 2022 and you wonder, well, we're throwing so much money into this economy this year. What kind of hangover are we going to get next year? Well, the reason why I don't necessarily think we're going to have a hangover is because going into an election year, I'm sure Washington is going to want to spend a whole nother slug of money to keep the economy, at a certain level going into those midterm elections. In addition, hopefully, the private sector can really take the baton and run with it here. But again, I think it comes down to where inflation shakes out with this growth rebound and what that means for inflation, what that means for monetary policy, because the Fed has a tough job ahead of them. The analogy I gave with the Fed is that they're driving 200 miles an hour right now in a 55 mile an hour speed zone. And while that was okay in 2020 at the depth of the shutdown, that day is over. We have 40% of the people in this country that are vaccinated. There is no reason to be pushing the pedal to the extent that they are. And I think that they have a tough game to play here because they're overstaying their welcome, which means that there's going to be a price to pay when they eventually do decide to taper and eventually raise interest rates.
Okay. Interesting. Look, Peter, thanks for making the time. It's about time we had you on the show and got you in front of me.
Thanks for having me on.
Yeah, I appreciate it. So you can hear more from Peter at bookreport.com, BOOCK report.com. That's where you publish, right? And you publish very, very frequently. So I recommend people check it out. Every day.
Yep.
Every day. Peter publishes every day. I publish once a week and I find it challenging. So hats off to you. It's impressive. Okay. Thanks so much, Peter. And love to have you back sometime.
Great.
As always, if you enjoy this content, please hit subscribe. I'd love to have you on the team. And if you want to take the next step and go a bit deeper with my content, I publish a free weekly newsletter every Friday where I debrief my portfolio. I distill the top lessons I've uncovered from the guests I've had on this show every week. And I talk about sectors and industries that I think are poised to move, areas that I'm looking for opportunity, and places that I'm allocating capital. I love writing it. We publish every Friday. The link is right beneath this video. Love to have you join the tribe.